SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-BAFFI Bocconi webinar on the size of central banks' balance sheets and financial stability. Over the last decade, the balance sheet of the Eurosystem has, similarly to other central banks worldwide, increased almost fivefold as a share of GDP. The fighting of various crises was the trigger and motivation for this expansion. The benefits of avoiding catastrophic outcomes, such as financial or sovereign debt crises, were seen to outweigh potential negative side effects. Now, the Eurosystem, like other central banks, needs to decide whether to reduce its balance sheet to non-crisis levels or to maintain a very large balance sheet in the post-crisis new normal. This question is closely linked to central banks' future monetary policy operational frameworks. I just mentioned the options floor versus corridor system for steering money market rates. From a financial stability perspective, the key difference between these options is the steady state size of the ECB's balance sheet. A supply-driven floor requires a very large central bank balance sheet. A demand-driven floor implies a somewhat smaller one, while a corridor system suggests a substantial reduction of the current balance sheet. In non-crisis times, what would be the reasons to maintain a large Eurosystem balance sheet? What financial stability risks might arise from maintaining a very large central bank balance sheet? Would potential benefits of a large central bank balance sheet outweigh the potential costs in terms of financial stability? Today's panel brings together top researchers who have published on several aspects on the interaction between large central bank balance sheets and financial stability. Let me express my special appreciation to Stefan Schmitz and Stefan Kerbl from the ÖMB's Financial Stability Division, who initiated this webinar and provided the major inputs in terms of research questions and speakers. Without further ado, may I hand over to Stefan Kerbl, who will moderate the webinar today.
Thank you, Ernest. The topic today is the size of central bank balance sheets and its implications for financial stability. The ECB has already announced on March 13 changes to its operational framework for implementing monetary policy. Therein, structural long-term operations and a structural portfolio of securities will, and I quote, make a substantial contribution to meeting banks' liquidity needs once the balance sheet grows again. So, the topic of large central bank balance sheets seems to be here to stay. Not only the size of central bank balance sheets is impressive, but also the speaker's CVs here is equally impressive. We'll start with Charles Goodhart, who is a most experienced central banker, and that is an understatement. He went to the Bank of England in 1968, that is over half a century ago, and his influential writings on central bank issues made him also a member and the deputy director of the Financial Markets Group at the London School of Economics. He also wrote on the optimal size of central bank balance sheets, on which, yes, a CPR discussion paper in 2017. Second, we will have Viral Acharya here. He is the CV Star Professor of Economics in the Department of Finance at the New York University Stern School of Business. He was also Deputy Governor at the Reserve Bank of India in charge of monetary policy, financial markets, financial stability, and research. Quite a portfolio there. He is a research associate of the National Bureau of Economic Research, a research affiliate at the Center of Economic Policy Research, and a research associate of the European Corporate Governance Institute. He's also been an academic advisor to many central banks and ministries of finance all over the world, and his primary research interest is in systemic risks, its regulation, and its genesis in government and policy-induced distortions. Today, he will talk about something that cannot be: liquidity needs in and liquidity abundant regimes, or not so abundant after all regimes. José-Luis Peydro will be third. He is a professor of finance at Imperial College of London, research professor at the Bundesbank, consultant with the European Central Bank and other organizations. He's also independent director at the state-owned bank in Spain, and his research mainly focuses on monetary policy, macroprudential policy and their interaction, debt systemic risk, and financial intermediaries. Today, he will share findings which have received considerable attention in central bank circles, financial crisis and monetary policy, and things that really keep policymakers awake at night. Tobias Berg is a professor at finance at Goethe University in Frankfurt and also a research fellow at CPR. His research focuses on how finance shapes firms, banks, and societies. And one strand of his research focuses on the effects of unconventional monetary policy on real estate markets, on which he will present a very recent paper today. Finally, Robin Brooks. He recently joined Brookings institution, and he's a senior fellow there, having previously been at the Institute of International Finance and chief economist there. And previous to that, he has been chief FX strategist at Goldman Sachs. He speaks truth to central banking power. He outlines fallacies and unfounded hopes. And today, we will enjoy a dose of his unfiltered opinion here. So Charles, if you would start, that would be great.
Thank you very much, Ernst and Stefan, for the introduction. I'd like to start by reminding people that this question about what should the size of the central bank's balance sheet be is very recent. We couldn't have asked that question before 2009 because the central bank's balance sheet was actually predetermined. It was predetermined by meeting the demand for notes and coin, by providing the reserve base for the commercial banking system, and also by whatever foreign exchange operations the central bank was undertaking. So there wasn't a question about the optimal balance sheet, though there had been in the 19th century and before, when the issue of the relationship or how much commercial banking a central bank should also do was quite lively. But between about 1914 and 2009, the question was completely impossible. It became possible because of QE, which vastly inflated the central bank's balance sheet. And that led, of course, to the question of whether the reserve, well, the question, having inflated the reserve base of the commercial bank so enormously, the corridor system no longer became feasible. So we had to switch to a floor-based system. And that, of course, raises the question about what kind of operational framework, monetary policy operational framework, the central bank should actually undertake. Whether it should be corridor, whether it should be floor, or some hybrid between them. I'm actually very glad to say that I don't have to say very much about this issue because there is a very recent and, in my view, excellent paper on this subject, which I'd like to recommend. It was an IMF working paper that came out in March on the ECB's future monetary policy operations framework, corridor or floor, that was written by Brando Marquez and Ratnowski. And in their conclusion, they actually suggest a hybrid approach in which you have a combination of a corridor, but also with the ability of banks to obtain a liquidity whenever they need one by a lending facility or frequent short-term full allotment lending operations. And they think that such a hybrid, a zero or near zero corridor, would be the most conducive for achieving the central bank's monetary policy objective. And it's quite a long paper and goes through the pros and cons of both the corridor and the floor. And I recommend it quite strongly. It would take me too long to go through that, so I shall suggest to anybody reading this that they look at that working paper rather than I try and trace it within a minute or two. Now, QE was and remains the effective response to a panic-driven surge in cash demand, which we still from time to time seem to have. But it has also been used. It was largely done by the Fed under Bernanke, but then got copied by virtually all the other main central banks as a continued and much extended procedure, even when the dash for cash had calmed down, as a expansionary measure. Now, what that actually does as an expansionary measure is to shorten the outstanding duration of public sector debt, effectively transforming it into overnight debt and greatly reducing the duration of the outstanding debt. And what is in a sense extraordinary is that QE reducing the effective duration of public sector debt was done at a time when interest rates were at an all-time low, which actually would suggest going in exactly the opposite direction. Now, this, in my view, either implied enormous, and as it turned out, unwarranted confidence that such low rates would remain for a very long time into the future, or alternatively, that short-term policy concerns about the difficulty of getting back to 2% inflation target took priority over much longer-term consideration. One of the features I think that this indicates is that the expectations of economists and central bankers are as much influenced by their relatively own short-term experience as the expectations of households and firms, as many of the recent papers from Chicago by economists like Acunto and Weber have indicated. Now, another question is whether the actions to influence the duration of outstanding debt are either fiscal or monetary. Now, my own answer to this would be that such measures are actually primarily fiscal. And if you're changing the duration of the debt, surely that's a fiscal issue. Moreover, the resultant changes in the monetary base had virtually no implications for the broad money stock. The relationship between monetary base and the broad money stock is now all over the place. So it's hard to argue that QE was, at any rate in this narrow sense, a monetary effect, but it was certainly a fiscal one. Now, I am reasonably confident, though I don't absolutely know, that whenever such QE or QT was under consideration, that the relevant fiscal authorities and the government were actually consulted and agreed to the actions undertaken. Nevertheless, I think there ought to be a consideration whether future decisions on QE or QT should primarily be the responsibility of the fiscal or the monetary authority. Either way, since the links between fiscal and monetary are clearly so close in this respect, does this limit the degree of separation and supposed independence of the two authorities? Does it matter? Now, for the immediate future, it doesn't really matter, because what we've got is, at the moment, a degree of QT in operation, but we similarly have expectations of, at any rate, temporarily declining interest rates. When you have such expectations of declining interest rates, it's actually pretty easy to sell debt. The problems are going to come when interest rates bottom out and the expectation is that they might actually increase. Under those circumstances, QT might actually influence the conditions in debt markets quite considerably. And under those circumstances, ought the decision on the continuation and extent and speed of QT be for the fiscal authorities when debt markets get into difficulties, or for the monetary authorities? I think that this is an important issue, which I hope that others will discuss. So that's enough for me.
Thank you, Charles, also for the time discipline. I would hand over directly to Viral.
Thank you so much for inviting me. It's always a tough act to follow, Charles. Before I get into my own remarks, I just wanted to add a little bit of continuity to the remarks that Charles had, which was that when I was at the central bank in India, my thinking was very much along the lines that he had, and perhaps that emerging market central banks had figured out QE actually long before I think the developed economy central banks did, primarily as a way to monetize government deficits. And all of the pressures that we had on our central bank balance sheet, its size, etc., were all about what portion of the government bonds would be held by the central bank. And I think this is a theme that Robin's going to touch upon quite closely for developed economies in his remarks. So maybe I should wait and chime in at that point. Okay, but I'll talk a little bit more about the private sector response to the central bank balance sheet size. I think most of you have seen this work before, so at the cost of repetition, let me just go through it again. This is based on work on liquidity dependence that arises from waxing and waning of central bank balance sheets with Rahul Chauhan, Raghuram Rajan, and Sasha Stefan. So I think the big puzzle that we tried to answer, Raghu and I did a theory paper first, and this, what I'm going to show you, is on the empirical paper, is why is it that in a world of such a large central bank balance sheet size, first trillion, then 4 trillion, then 9 trillion in case of Fed, and even if we have normalized some, we are still at 7 trillion. Why is it that someone can end up with shortages of liquidity in such a system? So we had the repo rate spike in September 19 when there was still $1 trillion out in the system. Then we had dash for cash, by which time we were already much higher than that because Fed started injecting reserves after September 19 repo rate spike. And then, even in UK, when Bank of England started its quantitative tightening, there was still enough liquidity to go around in the system, and yet pension funds could not actually get enough reserves, so to speak, to post as collateral on their swaps positions. And then maybe we had a full-fledged solvency cum liquidity problem in US banking last year. Now, each of these episodes, it's easy to find a proximate cause that, repo rate spike was caused by tax outflows and Japanese banks not being in the market for reserves. Dash for cash was caused by a very large shock and drawdowns of credit lines in response to that. Turmoil in UK gilts was a combination of fiscal and liquidity risk of centrally cleared derivatives. US banking problems, bad risk management at Silicon Valley Bank, combined with some contagion by analogy for regional and smaller banks, etc. But I think the bigger question we thought we might want to ask is whether the size of demandable claims in the financial sector has changed, which is that the calls for liquidity that are going to arise when stress happens fundamentally changes with the size of the central bank balance sheet. That's what we are after in this strand of research. And our main policy conclusion in a constructive way is going to be that rather than focusing just on the asset pricing effects of QE, which is what a lot of at least financial economics research has sought to do, maybe even macroeconomic research perhaps, that from a financial stability standpoint, the focus ought to be on the liability side of the financial sector, which is what is the stock of demandable liabilities in the economy, what's the set of runnable deposits, what's the set of runnable credit lines that the banking system has issued. And in that sense, from a financial stability standpoint, I think this is a nice follow-up to Charles's point, which is that we have to think about medium-term consequences of these balance sheet sizes rather than what happens on the day the big bazooka of QE and the forward guidance are unveiled in the first place. So just to make things precise, why? Because if you have an initial set of balance sheet conditions of the economy on the left-hand side, where you have the central bank balance sheet, a banking sector balance sheet, and a public balance sheet, the way quantitative easing typically tends to happen is that it's not just banks that are tendering their securities to the central bank. This is a little bit more true in Europe, that banks tendered their securities more, at least initially. But at least as far as the US experience is concerned, there's a lot of tendering of long-term securities, treasuries, and agency-backed securities from public, which could be pension funds, mutual funds, insurance companies, hedge funds, family offices, high net worth individuals, etc. So what happens when QE happens, when QE transaction takes place in the market on the right-hand side, which is shown, the central bank expands its balance sheet. It purchases securities and credits reserves to commercial banks. But because commercial banks are not the ones tendering their securities, the reserves that they get are effectively a credit to the deposit account of public or non-banks that have tendered their securities. So just simply by doing this accounting transaction, it's not just an expansion of central bank balance sheet, it's also an expansion of the commercial bank balance sheet. Now, of course, the question that would come up is, what's the big deal? You know, you expanded commercial bank balance sheets, but for every deposit that they created into the financial deposit account of non-banks, they have a reserve. Okay, but the problem is the reserves don't stay in the manner in which they were injected, because the private sector will have heterogeneity. Some banks will not want to sit on low-yielding reserves. They will want to use these reserves to expand the illiquid part of their balance sheets while keeping the deposits in place. And others like JP Morgan, for example, may choose to shore up reserves even further and become fortresses that will acquire the weak banks when they fail. Okay. So one very important point I want to stress is that even if the stock of demandable claims that gets created is exactly 1-for-1 for the reserves that get injected, the cross-sectional distribution of reserves after that might not remain the same. But in fact, I would argue that even the stock of deposits may expand more than 1-for-1 if there's an economic multiplier on this maturity transformation, especially if public, which tendered the treasury securities on the right-hand side, searches for yield and now finances some corporate activity. The deposits will now get transformed into corporate deposits, but there might be some investments and additional creation of deposits as a result of that as well. So to show that these things matter, I just want to show you very quickly a bunch of time series charts and then conclude. So this is the overall stock of uninsured deposits in the United States. And actually, most of these were demandable. I could show you that as well. What you see here is that prior to 2019 September, in the QT period, there is no stable growth or contraction of deposits. If anything, in some quarters, deposits are indeed contracting as well. However, once Fed rapidly starts expanding its balance sheet, there's a huge increase in uninsured deposits of the banking system. Cumulatively, this is over $3.5 trillion until the last quarter of 2021. And you can see that at its peak, it exceeds $800 billion when Fed purchases that quantum of securities in March of 2020. And I fully agree with Charles, at the point of the shock, it may be perfectly justifiable to do this. But the question is why these $300 billion bars of uninsured deposit growth thereafter. And that's because Fed is continuing with this policy even after the relative storm has become one of calm in the markets. So the uninsured deposits on the bank balance sheets grew from below 48%, around 47%, to close to 53%. And then there was a sort of this boom of uninsured deposits had a bust that happened with the interest rate hike in this particular cycle. Just to show you then that the cross-section of all this is pretty important, you can look at where did the uninsured demandable deposits grow. Note that because the credit of tendering is not to someone like me, I don't tender my securities via a prime broker to the Fed. It's mostly the financial institutions and then corporates who end up with these deposits. These are typically overnight transaction deposits, so uninsured demandable deposits. So you can see that the banking system as a whole in the United States has been growing its uninsured demandable deposits. In the last wave of pandemic QE, you can see that it's the smaller banks that are growing it relatively fast. And even if you construct sort of like a kind of like a liquidity coverage ratio measure, but sort of as an academic. So here I'm looking at uninsured demandable deposits divided by reserves plus eligible assets. Eligible assets may have interest rate risk, but I'm actually giving full credit to the banks for that. So I'm actually overstating the true liquidity in some sense. And what you see is a dramatic heterogeneity, which is that large banks, subject to the liquidity coverage ratio, have been bringing down their relative uninsured demandable deposits to potential liquidity in the form of reserves and eligible assets. In contrast, small banks are ratcheting it up. Okay? And I think this is actually an underappreciated heterogeneity of the banking system. There's a view that when liquidity coverage ratio is imposed on large banks, small banks are not treated. Actually, small banks are treated as well because in liquidity coverage ratio, there is a higher charge for uninsured deposits. So small banks now, in a comparative sense, become the primary sort of takers of uninsured deposits because they don't actually have to hold much reserves or eligible assets against this liability compared to the large banks. And then, of course, some of these problems of regional and small banks have manifested. The reason for showing this Silicon Valley Bank chart is, to me, it looks exactly a mirror image or close to a mirror image of the chart I showed earlier for the US banking system as a whole. So while it's tempting to write off Silicon Valley Bank as an egregiously poorly managed bank, I think it was actually, in our view, quite emblematic of sorts of problems in not as extreme a measure that are prevalent throughout the US banking system. Okay, a couple of last points. One, as time goes by, though, what you are finding is that the smaller banks are becoming liquidity dependent on the Federal Reserve. So here you see right from the time the interest rates were hiked and then into the Silicon Valley banking quarter, that banks which are below $50 billion assets in FDIC call reports now have larger and larger portion of their assets which are funded by other borrowed money. What is other borrowed money? It's a mixture of money from federal home loan banks and from the Federal Reserve. Prior to the first quarter of 2023, it's primarily federal home loan banks. Then Fed came out with an extremely cheap lender of last resort facility, and these banks have essentially switched over in significant measure to these. One last point over here, which is that is this a problem just for the US? To some extent, I would say more so for the US, because US has a large number of small banks that were not subject to the liquidity coverage ratio, and they have kind of looked the most worse as a result of the confluence of QE and then rate hikes plus QT. But actually, I've just got these charts recently from my co-author, Sasha Stefan, who is writing about these in the Geneva report with Stein, Kleisens, and other co-authors. And what you find here is that something similar has happened in Europe. Okay, so the dotted line shows you the reserves growth. The dashed line shows the time deposits at the bottom, and the thick black line shows the transaction deposits. The time deposits and transaction deposits are as a fraction of the overall deposit. So once again, you see a huge increase by about 30% plus in the transaction deposits of the European banking system. On the top right and bottom right, I have it for the large banks at the top and smaller banks at the bottom. And once again, you see a similar picture, not as extreme, which is that the smaller banks have grown their transaction deposit share to deposits by a larger amount. Now, liquidity coverage ratio, interest rate risk are better managed in Europe than in the US. So maybe we won't necessarily see the stresses, but I just wanted to highlight that similar patterns on stock of demandable claims are seen in Europe as well. Okay, so to just conclude with a couple of questions, we think that we are in a big difficult cycle of repeated liquidity provision, that banks are becoming dependent on the central bank in a world of surplus liquidity rather than the glut of liquidity actually making them not needing more liquidity. And we think this has to do with this fact that stock of demandable liabilities of an economy is endogenous to the supply of reserves, at least at a medium-term horizon, if not necessarily in the short term, when the bazooka might actually have the desired effect of stabilizing markets and stabilizing liquidity conditions. If banks become dependent on central banks, over time, there will be a loss of market discipline. We may or may not like market discipline, but it has some advantages like ensuring loans are not lent to zombie firms. For example, there is some concern of this on commercial real estate lending by Fed-dependent, smaller-sized banks in the U.S. economy. And as Charles and Robin have told us and are going to tell us, there's a risk of permanent fiscal financing as well. So broadly, I think my main message would be that we have focused a lot on central bank balance sheet as a monetary tool to achieve certain macroeconomic outcomes and avoid sort of recessionary or deflationary outcomes coming out of huge shocks. But at a medium-term horizon, we seem to have ignored financial stability consequences of this. And so two messages are, one, that you really have to then feel the stones. If you've been doing a lot of QE, then you can't do rate hikes or QT without worrying about how this demandable stock of liabilities will respond to that. At least for me, I would actually revisit the desirable scale, scope, and duration of QE, especially once you are past the initial period of stress and are pushing on a string, because I really don't see very convincing evidence that it pushes growth at those margins, but maybe it just stokes inflation and financial stability at that.
Thank you, Viral. Very clear messages. José-Luis, I think.
Yeah, so thanks a lot for the invitation, and it's a great pleasure to present, and even more after Charles and Viral. So my presentation is going to be a bit different. It's less about the size of the balance sheet. I'm going to argue about monetary policy rates. But before giving the presentation of Charles and Viral, I wanted to also say that maybe, since most of the people here are in the euro area, that maybe for the euro area, the size of the balance sheet of the central bank might be a bit different than, say, for the United States or the UK, or even emerging markets, in the sense that there is not a fiscal union and a banking union, both on the fiscal side for QE and on the banking union for, say, targeted LTROs or fixed rate for allotment. There might be a different role for a different size within an imperfect, say, monetary union. But my talk is going to be mainly about monetary policy and financial stability, since it was the other topic of this session. And I want to argue about monetary policy. The particular, so QE and QT are going to change the monetary policy, are going to change the interest rates. And a key aspect of financial stability is the risk of banking crisis, financial crisis in general, and in particular banking crisis. So I wanna argue that the current policy rates, they are similar in the history to a substantial increase of risk of banking crisis. So it's not an accident that there was a banking crisis last year, or those three banking failures last year in the United States. And since banking crisis is a somewhat rare phenomena, I'm going to use historical data. And this historical data comes from this paper with Jimenez, Kushinov, and Richter, and is evidence from history on the relationship between monetary policy and financial crisis. So very briefly, let me motivate it a bit before I give you the results of this paper and why that might be interesting for this talk. So in the current setting over the last 2 years, we have had higher inflation and raising monetary policy rates, including the initial quantitative tightening. Policymakers, in particular central bankers, have talked a lot about inflation versus recession. So the typical trade-offs that even people like Friedman were talking in the 60s, and then other people like Lucas in the 70s and other people. While there might be more than a non-financial recession, there might be potentially an implication for a financial crisis. And in the last 2 years, we have seen problems in the Silicon Valley Bank and other banks. We have seen problems when the ECB started tightening monetary policy in June 2022 with the transmission protection instrument, problems in sovereign debt, especially Italy. We saw the UK pension funds and gilts that Vidal was talking about. We have seen some crypto issues like some particular stable coins, commercial and real estate markets. Even in Europe, the price last year went down, and in the private credit market. And this is especially important after a low period of interest rates. In a sense, what Vidal was presenting right now is related to what I'm presenting, but Vidal was talking more about QE and QT, so the size of the balance sheet. I'm talking more about monetary policy rates. And in my case, I'm going to go to the history of banking crisis over the last 150 years. Before I tell you that, let me show you some important case studies of banking crisis. Since I am from Spain, let me just tell you, for instance, this one. So this is monetary policy rates. These are the different years. So, there was a time in which the South potentially was not the sick man of Europe, but more core countries were, based on the economies, the sick man of Europe. And so monetary policy rates were down. And these were too low for Spain and Ireland, for instance. And they stayed low for long, for 3 or 4 years. And then they went up. And after this, there was an important banking crisis. This is similar to the US Great Depression, to the Japanese crisis, to the Scandinavian crisis, this crisis in the UK, which was related to also lending to foreign companies, and the subprime crisis in the United States. Now, these are particular case studies. So in this paper, what we do is to analyze what is the impact of monetary policy dynamics on banking crisis. So what is the full path of monetary policy rate before a crisis? Is this case studies that I just showed you happens in general in crisis? And thus, in a current environment like today, in which we have a reduction in rates, then we have low for long, and then a massive increase in monetary policy rates, whether it increases crisis risk. This will be also important for the size of the balance sheet, for QT, in the sense of how much currently one can increase interest rates. And what are the underlying mechanisms? A bit what also Vidal was talking about, sometimes excessive risk-taking. We do this especially with historical crises. Why historical crisis, as I was saying before? Because, in order to get many, many crises, like for instance, we get in this sample 80 banking crises and hundreds of recessions in 17 countries, including Germany, the UK, United States, Australia, Japan, etc. And then we use the monetary policy rates. We also use long-term interest rates and other things. But say the monetary policy rates, either the raw one or relative to the systematic part of monetary policy, like GDP growth and inflation. Now, what are the main results? This is a very long paper, more than 100 pages, and a long introduction of more than 1 hour and a half, or an hour and a half. So I'm going to give you just basic results and a couple of charts. So the first result is that the policy U rate, again, reducing rates, then low for long, and then increasing monetary policy rates, increases banking risk. And this is very different from non-financial recessions, even from non-financial deep recessions. For recessions, what matters is just increasing rates, as Blinder or Friedman and other people were talking about. But for financial crisis, it's going to be the whole U, and this will go to the mechanisms. And the stronger, the deeper is the U, that is, the lower is, the more the central banks lower the interest rates over and above what the Taylor rule was saying, and the more they increase it afterwards, the more higher the financial crisis. Before I tell you a bit about the mechanism, let me just give you a couple of results. So these are all these 17 countries over these 150 years, and using all the crises. And if we condition on a crisis, we always find this U before the crisis, not on those case studies that I just presented, or in all the crises. And even a bit stronger for the deep financial crisis, and even more stronger after the Second World War. If you see this U, and this is very big numbers, and the U, this is a bit different from long-term interest rates, and especially for monetary policy rates around recessions, even the worst non-financial recessions. Here, there is no U for financial recession. So it tells you that there must be some mechanisms which are different for banking crisis vis-a-vis non-financial recessions. Now, let me just put it in another way. If we divide monetary policy cycles in this U, or the inverted U, raise and cut, or raise, or cut, okay? And you need somewhat a long period of time, like 5 or 6 years of being cutting and being low for long. If we analyze the post, and all these different monetary cycles have the same probability, okay, around 25%, what we see is that all the banking crises after the Second World War, 100% of them came from the U shape. If we analyze this for non-financial recession, it will be only 30%. So it's something about the banking crisis. It's not about recessions, not even deep recessions. And if we take all the crises in all the 150 years, it will be 55% are coming from this U, despite that it's only 27% of the cases. And so basically, there is a risk in the current setting that we might end up in a crisis. Now, what are the mechanisms? So the mechanisms is that when the monetary policies are cut, and especially they are strongly cut over and above the systematic, what the systematic monetary policy says, say a kind of Taylor rule, then you will have higher credit and asset prices. Let's call it like a red zone. And then there will be a much stronger reversal in asset prices and credit if monetary policies are raised, and the higher you raise, the more it is, generating a banking crisis. So we have two things which are new, apart from the mechanisms, is that, if there is, so in a sense, it's not low rates or high rates what matters for banking crisis, is this combination of you need this low for long in order to create a vulnerability by taking a credit boom and asset price bubble. And then this will, burst when you massively increase the monetary policy rates. Also, many people in the past have argued that it's just credit and asset prices what matters for banking crisis. And what we show is that it's a combination of the two. That is, if you have just high credit booms and asset price, this is not generating a crisis. One way to see this is the following. So as you can see here is this red zone of very high credit and asset prices, so elevated credit and asset prices both on stocks and real estate, and this U-shape of monetary policy. Then you generate a financial crisis. You can go up to 37%, so you have a red zone and you have a U monetary policy rate, you are generating a probability of a crisis of 37%, which is pretty high. If you see the red zone, you see this number, red zone, so the third row, red zone, but no U-shaped monetary policy, look here. There has been, after the Second World War, there has been 71 red zones, like very elevated credit booms, very elevated asset prices, including real estate. But only one of those instances end up in a banking crisis because the monetary policy was not following a U. So it's truly a combination of the both that matters. We have many, many results. I cannot tell you all of them, but since Charles and Robin are talking about fiscal, and Viral a bit of everything, and I want to talk a bit more on banks. So let me just finalize the last slide with this regression. So we have seen, of course, when interest rates go up, this is good for banks in the sense that they get more profits and then they get higher stock returns. But the problem is that, so if I would put here what is the change in interest rates over 3 years and what is the implication for return on equity loan losses, so NPLs, and stock returns, this alone, increasing rates, it will be positive. But when there is if you combine this with previously there was the U, that is, there was a cut for long period, like 6 years of low rates for long, and the more excessive the worse. Then after a period of low rates for long, if you increase rates over the next 3 years, at the end, you will start having non-performing loans, which are these ones. This will be a reduction in return on equity, and this will be a reduction in stock prices. It will lead to a bank equity crisis, and it will lead to a banking crisis. So basically, the point that I'm making in this presentation is that potentially the size of the balance sheet of the central banks might be ideally going down, but now that we have so much big debt and interest rates are high, a potential risk is that if interest rates are high, after all these low for long, there might be a banking crisis. Thanks a lot.
Thank you, Jose. Great. I think the next presentation will also be about banks and credit risk. Tobias, Berg, please.
So thanks, first of all, for having me here, actually. And similar to Jose and Viral, I'm going to talk about financial stability and about the banking sector. So Viral's presentation was actually focused on the effect of QE on the liability side of the bank balance sheet. And I'm going to look at the effects of QE policies on banks' asset side, so the lending business they are doing. And in the paper here, we look at one particular program, the corporate sector purchase program. So since 2016, the ECB has actually bought more than 300 billion of investment grade rated corporate bonds. And this is a quite sizable amount, roughly a third of the outstanding eligible corporate bonds, but also sizable relative to Eurozone bank lending to non-financial corporation, roughly 7% of this amount. And the rationale of this program was actually to overcome credit supply frictions by providing credit directly to the real sector. And we're actually asking a pretty simple question. What if the banking sector frictions that these programs are supposed to address actually don't exist? And you might ask, why do we ask this question? It's a little bit like asking what happens if a firefighter pours water over a house that is not burning. But we argue it's important, A, because typically, in particular in the Eurozone, we have a lot of heterogeneity within a currency area. So you might want to fight fire in some of these countries, but the same conditions might not apply to other areas within the currency union. And number two, when you unwind these type of programs, there's also obviously the question about the optimal timing of the unwinding. What we are looking at is Germany, a setting in Germany. And when the ECB started to buy corporate bonds, Germany did not have a problem with credit supply. So in surveys, only 5% of German firms considered access to finance a problem. Unemployment was also pretty low. So this was clearly not a country where these policies were designated. And I'm not going to do a deep dive into methods here. That's in the paper. But for those interested, these are kind of standard difference in difference estimators with the typical estimators to separate out demand and supply. I'll skip that in the interest of time. And let me directly come to our key result. So what happens is actually that the ECB buys corporate bonds. So that means that these large firms with an investment grade rating, they shift from bank lending to bond issuances. And this frees up lending capacity in the banking sector. So the question we ask, the first question we ask is, where is this additional lending capacity actually going to? And what you see hopefully quite nicely in this chart is that the decrease in lending to eligible firms that now access the bond market is fully compensated by an increase in lending to the real estate sector. So in Germany, the entire capacity that was freed up by the corporate sector purchase program ended up in additional real estate lending. Now, to make matters even worse, if you dig a little bit deeper, then all the additional lending ended up in the real estate asset management sector. So there's no additional lending to the construction sector. There's no additional lending to the real estate developers that might develop new properties. But this additional lending goes entirely to real estate asset managers in Germany. These are typically small firms, 10 to 20 million balance sheet, that simply invest in existing houses or properties, and thereby, in this case, obviously, push up the prices of real estate. We find no significant additional lending in any other sector within real estate or within the economy or more broadly. So the question is, what's the mechanism actually at play? Why does it all end up in real estate as in the real estate asset management sector? So from a supply perspective, it's attractive for banks because this is collateralized, typically attracts a low risk rate under prudential regulation. But there's also a demand-based argument that intersects here. So if you want to develop a project, you need a plot of land. If you want to build a house, you need capacity in the construction industry, all of which was not available in Germany at that time with a record low unemployment rate. Real estate asset managers, on the other hand, can scale up their business quite easily. Yeah, with very few people and large balance sheets, you can actually invest in existing properties, push up prices here. And this is kind of the main mechanism at play that we identify here as a reason for this behavior. As a result, real estate prices increased significantly in those counties in Germany that were most heavily affected by this CSBP program. Okay, so we look at various measures of real estate overvaluation. I've plotted here the price to rent ratio, but all indicate an increasing overvaluation of real estate markets in Germany caused by the CSBP program. And what we also find is a quite high elasticity of housing prices to credit supply, much higher than identified in the prior literature. And this is potentially worrying because it's uncomfortably high. And the explanation, we argue, is quite simple. If you don't have any more people to build new houses or plots of lands to develop houses, then all the additional lending capacity just goes into increasing prices of existing houses and apartments. And this is why in such a situation, with little credit demand by other industries, with full employment in what we call a credit-saturated economy, the additional lending all goes into real estate asset managers, pushing up housing prices. Now, interestingly, the ECB for other programs, the TLTRO, for example, explicitly considered real estate lending. So they were concerned about real estate prices and therefore for the targeted long-term refinancing operations did not allow for lending to the real estate sector. Yeah? However, in the CSBP program here, it was obviously hard to exclude that because it's more an indirect effect. You free up lending capacity in the banking sector. The banking sector decide on its own where to channel the money, and they channel the money for the reasons described entirely into the real estate asset managers. Now, from a banking sector stability perspective, this led to a decrease in banking sector stability. It increased the riskiness of bank lending, profitability increased because of additional competition from the ECB, and banks relied more heavily on real estate collateral due to the CSBP program, and that was not fully cushioned by regulatory actions. So to sum up, we document unintended side effects of the CSBP program in what we label credit-saturated economies. So if you're a firefighter and you try to extinguish a fire even though the house is not burning, then this is not for free. There are unintended side effects. It fuels overvaluation in the real estate sector, and it impairs financial stability. Thank you.
Thank you, Tobias. Yeah. Okay, now Robin, to you.
Okay, thank you so much. It's a real privilege to be in this incredibly great group, and I can't say how much I've loved listening to everyone's presentations. So the focus here is on central bank balance sheets and financial stability, but there are other forms of stability at play in the big picture. One is fiscal stability, so debt levels, and obviously what central banks do has implications on how easy it is for central banks to run deficits. And then more importantly, perhaps underlying everything is political stability. We have the politics across many Western democracies, which is deeply split in the United States, for example, but many other countries too. If you have these deeply split democracies, then doing politically costly things like raising taxes or cutting spending, it's painful. It's not a winner for votes. And so you run deficits, and so debt issuance and the central bank role therefore becomes highly political, obviously, in this politically very split environment. And so I'm going to focus on the nexus of fiscal dominance here. So it's one particular aspect of central bank balance sheets. And I want to start where Charles started, which was, this is all pretty recent. We really started central bank balance sheet expansion, and in particular purchases of sovereign debt in March 2009 with the Fed. It was all completely novel. It was basically an extension of cyclical monetary policy at the zero lower bound. But what's happened since then is nothing remotely cyclical, because debt holdings of central banks largely only go up. There are very few central banks that run their holdings of sovereign debt down. The right chart shows you holdings of sovereign debt in percent of GDP. You can see, obviously, Japan is a big outlier, but there is an increase across many other central banks as well. At the same time, we observe, and José-Luis flagged this, and Viral too, increasing number of bond market accidents. The US had one in March 2020. The Fed bought over $1 trillion in treasuries within 7 weeks. We had the Eurozone in June 2022, which José-Luis mentioned. That gave us the TPI, the anti-fragmentation tool, the UK, the LDI thing in September 2022. So obviously there's it seems on the surface, certainly a nexus with financial stability from these growing balance sheets and what it's doing to the risk distribution. So I'm going to talk about central banks in the G10, but I would say Viral's perspective coming from EM is increasingly relevant in the G10. So let me start with the example of Japan. So the left chart shows you net new issuance of longer term debt by Japan's government. So this is the issuance of JGBs in the black line. And then from the flow of funds, who is buying these JGBs? And you can see that even at the current juncture, you know, and we've obviously heard a lot about the end of yield curve control in Japan, but even with that, the JGBs the BOJ is basically buying 100% of net new issuance. And so what is really happening is the debt level in Japan is so high that it really is not practical to allow the funding to go back to private markets, because it is possible that interest rates could be quite a bit higher if we allow markets to set those interest rates. And so the BOJ is, whether we have an end to YCC or not, effectively capping Japanese yields. Now, in the G10, the narrative is, well, what's the big problem with that? Inflation is low, so we can use central banks to finance deficits. But in reality, Japan is a fascinating example of what the repercussions of this are. The right chart shows you the real effective exchange rates, CPI-based from JP Morgan. You can see that since COVID, so since the end of 2019, the Japanese yen has fallen more in real effective terms. So the Japanese yen is the black line, has fallen more in real effective terms than the Turkish lira. So this is very much a very big decline. It is highly politically contentious in Japan. You will remember last year that the Ministry of Finance intervened to prop up the yen while the BOJ simultaneously was doing things to ease policy and to weaken the yen. So these are highly distributional policies. They, in this case, are benefiting exporters at the cost of importers. So the question is, is this politically sustainable, and are the costs transparently transmitted? Now, I put the BOJ at one end of the G10 central banks, so full fiscal dominance, basically. The Bank of England, I see, is at the other end of the spectrum in the G10, zero fiscal dominance. And a lot of that has to do with Governor Andrew Bailey essentially catapulting the Truss government out of office, which really in modern times is unprecedented. And so every other central bank in the G10 I see lying somewhere in the middle. So the ECB, as José-Luis was careful to say, the ECB is in a particularly difficult spot here because Europe, the Eurozone, is not a fiscal union. That makes the ECB's job very complicated. Now, it is my view that ECB actions overall are helping to compress interest rates in high debt sovereigns. So the left chart shows you the spread over German bonds for 10-year sovereign bonds across different periphery countries. We have a natural experiment on what happens when the ECB says we will not do anything to cap interest rates. This was Lagarde's comment in the March 2020 press conference when she said the ECB is not here to close spreads. Spreads widened out very sharply immediately. It is my conviction that if the ECB said this again today, spreads would widen out in similar fashion very quickly. The ECB at various points has used some of its tools to intervene in what looks like capping spreads. So PEP reinvestments in the right chart were used in the middle of 2022 to cap interest rates. This is obviously when the inflation scare post-COVID was especially high. You will see there that net reinvestments into German bonds were very negative, and basically that was used to finance purchases of Italian and Spanish sovereign bonds and stop the rise in those yields at the time. Now, the basic situation in the Eurozone is that we have periodic interventions when there are bad shocks to enable deficit financing at relatively low interest rates. And these periodic interventions are basically an ECB put. They mean that private markets are learning. They are obviously looking at what central banks do, what the ECB does. They are inferring a reaction function. They mean that the left tail of the distribution gets truncated because the ECB starts showing up as a buyer. And it means that all else equal, interest rates for high debt sovereigns are lower than they would be without this ECB put. And that means that in the trade-off between financial stability and fiscal stability, you are overweighting, rightly or wrongly, financial stability over fiscal stability, and it makes debt reduction even less likely. Now, the United States is typically seen as apart from all these issues. It is definitely not. These two charts show you issuance of debt by the United States, and then I've, in the right chart, put four of the peers across advanced economies. And I'm breaking out here issuance of debt 1 year and shorter versus longer term debt in blue. So short term issuance is in red. You can see that what the United States has been doing recently has been shifting almost all of its debt issuance to very short tenors. So this goes again to something that Charles was talking about at the beginning, and also Viral. You know, we're doing a lot of maturity experimenting here, and what the United States has been doing partly on the issuance side is because there's been so much upward pressure on long-term interest rates post-COVID. Issuance has shifted basically to the short end, and that is just another reflection of stress coming from markets to fiscal, and then sovereigns doing different things to try and offset that. And so with an almost 10% of GDP deficit in the United States as we go into these elections, 80% of that issuance is being funded 1 year or less. That is very unusual relative to the history of the United States. It is also very unusual relative to what any other advanced economy is doing currently. And so it is another example that, you know, no one is immune from this particular issue. So let me stop my comments there.
Thank you so much for the great presentations. I maybe let me just try to summarize a bit or try to frame discussion. So I think Charles and Robin have talked a little bit about balance sheet size and especially pointed to the question of central bank independence, if that's possible or not, and what implications that might have, or the issues that might arise there on this front. Whereas José-Luis and Tobias focused more on the consequences for credit risk, and Viral on the effects on liquidity risk. So those three on the risk side, and maybe like a first question that I think would be interesting. Do you share this this view that those are like two separate, somewhat separate issues? And I also give you, of course, the opportunity to respond to the other speakers if you want.
Thank you very much. Just about Robin's, you said that Andrew Bailey got rid of Liz Truss. That's actually not the case. It was the gilt market who did. Andrew Bailey actually then sort of reversed tack and felt that he did an excellent job in stabilizing the gilt market and the British economy at the time. The issue of, and what Robin has also mentioned, is the question of the relative priority given to financial stability as related to fiscal stability. I think at any rate in Europe, we've not done a bad job of financial stability, but I think that fiscal stability is going to be an increasing problem everywhere. And it is not improved by the fact that the duration of the debt has become so short. Again, I entirely agree with Robin about the fact that the US issue of debt is now entirely short term, and that the whole basis of QE is to shorten the effective duration of debt. If interest rates at some point start to come back up again from the current decline, which is generally expected, the situation actually could become really quite serious, particularly on the fiscal side. And again, not only in Europe, possibly particularly in the United States. And at any rate, in Europe, I think that the issue of fiscal stability is understood. What worries me is that neither political parties in the US, for different reasons, neither Biden nor Trump, seem to be at all concerned about this particular problem. And given the combination of high deficits, the CBO projecting an unsustainable trajectory for fiscal policy in the US over future years, the outlook on that front, I have to say, I think is exceedingly worrying and has been made worse by what has happened to duration. Anyhow, that's enough for me as an immediate response. And I share the concerns of the other speakers about financial stability. What I understand entirely what Viral is about. What I didn't really get from his presentation is what the policy implications of that might be, and what do we do now?
Yeah, no, that's a good question, Charles. Personally, I'm a bit worried that we are actually trapped. I think we are not going to be able to come to smaller central bank balance sheet sizes without undertaking actually a fair bit of pain along the way. So I think that I was saying, okay, you feel the stones and you move ahead at each point. I think what could work in my view is, but I don't have much support even necessarily within co-authors with whom I've done is that I would personally prefer to just make the banking system extremely stable. So, US has responded to the recent stress more again through patchwork by saying, okay, we'll give banks liquidity, etc. I think it would be far better, in my view, to recognize the interest rate risk of banks. At least that's one that has manifested. Rates are likely to stay higher for longer, both because of fiscal and inflationary reasons. Because I feel that if you lose that, I'm sort of very clear that if you don't maintain financial stability, all kinds of bad policy outcomes come about. So I don't have much of support for this, but I would actually very strongly recommend that the Fed does a serious asset quality review of the banking system, including of the smaller and mid-sized banks, recognize the interest rate risk which is out there. It will most likely lead to a repricing in the bond market because they will actually not now be keen to hold these risks. But actually, that might be the best dose of vigilantism that may be provided to both the presidential candidates, which is let them know that if the banking system had not bought so many bonds that are not currently being marked to market, you would not have been able to float so much debt at such a low cost. And so be prepared to face higher costs and bring this down. So it's a little bit of a controversial remedy, but I would say in interest of financial stability, you need to recapitalize, but it might actually be the best medicine even from a fiscal front because you will actually make them experience probably what are supposed to be maybe true costs of borrowing.
What people like Jamie Dimon and other reasonably thinking bankers would say is that if you're going to increase the capital requirements, what that will do will be to shift into financial intermediation further out of the banking system into the non-bank financial intermediaries who are even less well regulated than the banks themselves. And how are you going to prevent the toughening up of regulation from actually making banks less competitive?
Yeah, I agree. It's a tough question. I think for a lot of the smaller banks, though, I feel a little bit less worried that their activities are necessarily going to shift out as quickly to the non-banks. I think for the larger banks, I agree. I think for the non-banks, probably one has to entertain at some point something like Mervyn King's proposal that whoever has demandable liabilities ultimately has to shore up some liquid collateral on their balance sheets actually to do this. And I think this overall idea that maybe it's the aggregate stock of demandable liabilities that matters rather than just that of one part of a financial system probably requires some thinking as well. So I guess that's probably another big regulatory change that would be required to make that happen, because there are no powers basically to implement something like that in many parts of the world right now. I mean, like legal powers for the regulators. So actually, they would have to be given these powers to do this. If I could just make one quick comment, if that's sorry, Charles. Sorry.
Quick, please, quick.
I was just going to ask Tobias. I follow your analysis very clearly about the problems about CRE lending to commercial real estate driving up house prices. But now we are where we are. What would you actually suggest that we do? And I can see your arguments about why it was rather unattractive to have followed this particular route. But we are where we are. Where should we go now?
I think that's one part of the problem, that it's not simply easily reversed. You cannot say we created this problem with that type of intervention, and now by just stopping it, running down balance sheet, we run the exact same in the reverse. I think there is no easy solution to this one. And let me maybe also make a comment a little bit more generically. seems to be that almost all presentation we've seen today are a little bit of a trade-off of short-term versus long-term effects, and central bankers always looking at the short-term effects first. Like if I look at José's presentation, if you keep rates for low for longer, you maybe avoid an adjustment in asset prices. If I look at mine, if you have heterogeneity, then those areas of a currency union where credit supply is lacking, they have a short-term problem, but the buildup of asset pricing bubbles is something which is a little bit farther in the future. It's similar for the discussion of fiscal dominance, or with Viral's paper, where in the short term you solve a problem by doing QE, but in the long term you create a lot of uninsured deposits that might create financial stability risk. And it seems to me that in all these cases, when you have a short-term problem that you want to solve that might create a medium-term problem, then the big emphasis is always on solving the short-term problem first, and then seeing how to deal with kind of the longer-term intricacies later.
Yes, thank you very much. José-Luis, do you want to respond as well to the comments, or should we switch to the audience, which also a number of questions now awaiting?
There was a question on the audience on macro proof, I mean, related to what Tobias was saying right now, and so maybe there are other policies that can do some tricks, but I don't think so, in the sense that, so this was a question, no? And so, you know, macro proof is to some particular participants, like for instance, banks, so they can be unregulated and pass the risk to the non-banks. And then sometimes central banks, potentially they should have into account not only inflation and GDP and employment, but financial stability. And so they might deviate from the Taylor rule and sometimes tighten before they do a too low for long. So maybe the solution is also in the monetary policy, not just relying on, say, the Steinberger rule of 2 instruments, 2 objectives, and then leave everything to macroprudential policy. That will be my comment.
Thank you. Ismail Sarek asks, can we identify an optimal size of the central bank balance sheet, or is this something that's too difficult to do? Maybe Robin or Charles?
I would say that I think it is generally believed that it is now too large. The question is not so much at the moment whether there is an optimal level that we can identify, but what is the right rate of change of QT? How large should QT be? And should QT be related to conditions in the debt market, in the US T-bond market? And at the moment, with expectations of interest rates going down, QT isn't having much effect at all. But change the context, change expectations of where interest rates might go, and the context of where you think the future lies, and even relatively small QT might have a very large effect, simply because it hasn't had any effect over the recent time period, does not of itself imply that in other conditions it might not be really quite important.
Can I just add something to that? Let me rephrase the question. The question or the size of the central bank balance sheet, or how much runoff we now do, is a question, again, going back to the trade-off between financial stability versus fiscal stability and some of the other longer-term considerations that we mentioned. We worry about financial market volatility if we do balance sheet shrinkage. We worry about access of governments to public debt markets. And so I think that is shaping a lot of this debate. And so really, it is an implicit judgment that we are making currently that we really don't like financial market volatility for various reasons, and that has lots of unintended consequences, in my opinion. The only other thing that I would say, if I may, my hat is off to the BOJ and the Fed and most other central banks on data transparency. It's fine to do QE and have large holdings of government debt if there's a political equilibrium to support that. And of course, the ingredient for that is high data transparency. You are completely transparent on what you are doing so that voters can see what is happening. And here, I think, as much of a fan of the ECB and the Eurosystem as I am, I think the data transparency at the ECB is less than some of its peers. So the BOJ publishes daily data on JGB buying. The Fed publishes weekly data on its treasury holdings. The ECB published monthly data on the PSPP program. But with PEP, it went to 2 monthly blocks of data, even though it started to deviate from the capital key. And so I think that one thing to improve and to discuss to boost the political buy-in for this, which is ultimately needed, is to increase data transparency in the Eurosystem on this particular issue. Thank you.
Yes, also on the Eurosystem, Stefan Schmitz had a question, which is now the new framework is a combination of a floor system with full allotment, but the main refinancing operation at a small markup above the floor. And it constitutes an unlimited secured liquidity line provided by central bank against illiquid collateral without upfront fee. And he says that on top of the system-wide mispricing of liquidity and liquidity risk, the system leads to, in his opinion, the subordination of unsecured deposits and might just speed up bank runs and also makes resolution close to impossible when the large share of bank balance sheets is encumbered. And yeah, regulation, macroprudential policy try to fight this off? Maybe this is again addressed to Viral, maybe perhaps, or to José-Luis, who has also researched on macroprudential policy.
Yeah, I would just go back maybe to maybe my earlier response to Charles, which is, I think in a way there's a medium-term issue of the asset side of the macro, which can be dealt with macro-proof perhaps, but I think the short-term liquidity risk issues, I think, have to be, managed. So one option is to go the Fed way, which is to have just provided a very generous lender of last resort. My sense is that just kicks the can down the road and hopes that things will revert, rates can be cut in reasonable time so that the treasury losses actually start coming back into treasury gains. The other alternative is to recognize that there is liquidity risk right now. So I would be in favor of actually recognizing that some of it will have to be met with capital, as I was saying, because these balance sheets are holding these assets. And I know it seems tough, but from my experience in India, it makes you unpopular to do these things. But in the end, it pays off. We did a marking to market on the bank balance sheets at the same time that we were cleaning up their balance sheets for non-performing loans. Everyone thought that this is going to be a havoc for the yield curve. Nothing like that happened. Pension funds and insurance companies bought securities once the long-term yields went up slightly. So it was a little bit of a readjustment of duration. Banks ended up shortening duration and non-banks ended up lengthening their duration. There were no dramatic consequences for the financial system or the yield curve. And when we had a non-bank problem, we chose to basically weed out the ones that were in trouble rather than actually just give a generous lender of last resort to everyone. So my sense is this idea that when there is volatility, I think to borrow Robin's term, I think I agree with it. We are in the situation where central banks are not willing to tolerate any market volatility. I think this can't be a good way to run the system. I think when there is volatility, usually there's a cause for it. You have to identify the balance sheets and the leverage that has contributed to it. You have to address it. It takes a little bit of time. It might look painful in the short run, but it's not like the world comes to an end. We are not talking about like a Great Depression kind of a scenario or something like that. Maybe we were at that at the time of COVID, but none of the other events that we discussed have been similar events. And so I feel there is virtue to doing the right thing, taking a little bit of time. Maybe the lender of last resort can be used just to buy that time. Maybe it's for 1 month or 3 months or something like that. But then you have to fix the balance sheets of the banking system on liquidity and capital. And if you don't do that, it will come back and hit you in some other form when other risks materialize.
Thank you. We have a question from Horvath, who is asking to all participants, if we now understand that actually QE might not be the problem phrased in a provocant fashion, but the real issues start when you do QT, when you raise rates. Shouldn't we take this into consideration? The problems, is the real culprit really QE, or is it rather QT, or shouldn't we raise interest rates more slowly in order to avoid a sudden financial stability problems?
I think Tobias was exactly right, saying that the problem is that central bankers, like many others, always emphasize the short term too much. We wouldn't be talking about QT if we hadn't had QE to begin with. But we are where we are, and QT is with us. And the question, I think, is how fast should it go? And even more, I think that one should expect and plan to have QT flexible, depending on the absorption ability of the debt markets. I think trying to stick with a QT program, come what may, would be mistaken.
Just add one point to that, which is, there was high inflation, and so, you had to respond to that in some way. Now, whether rates and QT or it should have been both, of course, is a question that could be considered. But essentially, I think to go back to the way Tobias framed it, is that there was a trade-off basically in the medium term, which is that you had a monetary policy versus a financial stability trade-off. So, but that's the challenge. I think when you have done too much, you end up with these things where one arm of the central bank is undoing what the other arm of the central bank is doing. So.
Yes, I understand we have a question also via the microphone. Is that correct?
My point would be, as inflation is falling strongly and going back to targets, and as monetary policy is going to be eased in the foreseeable future. Now the question is the time for QT and thus for balance sheet reduction not actually over? Is the window already closing? Is it possible anymore? And I also want to pass on the baton, if possible, to Philip Hartman, who also has a question.
Thank you very much for all the presentations, and I heard all of them except Charles's, so I hope I don't say something that he has already covered. So first, let me first say that I think I can share the tone that cut across many of you, that we have to be careful that in our efforts of short-term stabilization, we shouldn't forget the medium and the long-term effects. So that's very clear, and that's here. It's at the core of the issue. But I did want to say that there were a number of financial stability implications of balance sheet sizes and changes in balance sheet sizes that are in the literature and that were not covered in this in these different presentations. And I just wanted to mention one or two of them just for the sake of completeness and to illustrate that it's a bit more complicated than just one directional. It's not an entirely unidirectional, even not short-term versus long-term. So the point that I wanted to take from the literature on financial stability in the long term is there was this point by Copeland, Hansen, and Stein that the yield curve, the sharp increase of the yield curve in the short end suggests the shortage of safe assets. So in that regard, the creation of safe assets through central bank reserves is a long run, can be a long run stabilizing factor, because otherwise the private sector would have to generate these short-term safe assets, and usually does it with short-term liabilities, which would then create potentially runnable instruments of financial intermediaries. So that's the Jackson Hole paper by Copeland, Hansen, and Stein, and you can have these arguments. So I just want to say there is some effects that also go the other way. We also need to take into account. The second point I wanted to make is just that I'm not sure anybody of you talked about the unsecured market and the market discipline. There is this, particularly if you listen to macroeconomists, this feeling that actually, so the size of the balance sheet and the reserves that were created crowded out a good share of the unsecured money market, right? And the question is a bit, does it come back when we reduce balance sheets? So in the macro world, there is this impression, one hears very often, that actually the market discipline that the unsecured money market would exercise is actually fairly limited, and it's held against the need to actually reactivate it. So its social value is kind of questions that maybe even a market where crises are regular. I'm not sure, you are pretty much at the end of your of the event, but if there was time, I would have asked the view of the panel what the balance is on this argument. What is the value of the unsecured interbank market for market discipline, risk management of financial intermediaries, and therefore also the stability of the financial system in an ex-ante sense. That was it. Thank you.
Thank you for this intervention, Philip Hartmann from the ECB Deputy General. Maybe the unsecured market, and that's probably in line with what Viral said about liquidity and dependence on the central bank. Maybe Viral, you would like to respond to that?
Yeah, I think my sense is it's probably good to have a balance in the system. Like I'm very perhaps ideologically or philosophically against overbearing government interventions, even though I sort of see the value of the interventions when there are large shocks. But I think it's a little bit like steroids. You don't want to be running your body on steroids all the time. You might need it when you have a severe asthma attack, but then your lungs have to function ultimately on their own, I think. So maybe this is a very philosophical answer. I would prefer a balance between private markets and governments rather than government balance sheets of a central bank being so large that for a small shock, there is no need for an unsecured market at all. And then the first day you need it, it's not there, and now you have to just keep ratcheting up the. So I think the first point I would actually contend that, if I could say that, I think they got it wrong. I think Copeland, Kashyap, and Stein got it wrong in my view, because creation of reserves, I just argued and we find, creates actually its own uninsured demandable liabilities in the system. So I think this idea that I'm going to issue reserves actually to meet the scarcity of safe assets, and somehow I'm crowding out the private creation of money in the process. Actually, this is wrong. It's not met in data. When you create reserves, you actually create demandable money-like liabilities on the right-hand side of the banking system. I think they weren't thinking about how the reserves are financed by the commercial banking system. And therefore, there was this idea that we can meet the scarcity of safe assets by just issuing.
So, yes, thank you for the response. Thank you all for the comments. I hope we can follow up also maybe bilateral on those points. It was great. We had a lot about central bank balance sheets and the potential big footprints such large central bank balance sheets can exert. I'm sure that the contributions today of all speakers left their footprints as well, footprints for thoughts and ideas to follow up on. I sincerely thank the panelists and also the audience for great questions. And we have, I think, reached the end of this discussion, and I wish you all well and goodbye. Thank you very much.
Bye-bye. Thank you.
Goodbye.
Thank you so much. Learned a lot. Thank you. Bye.